I've been trading for a long time. I take a lot of small losses, a lot of small winners, a lot of break-even trades, and I trade all year long, really, to find a trade like this. I've got this trade going. It's still going. The S&P 500 has far exceeded where I thought it was going to go, and that's why when it comes to trend following, I don't like to call a top. When you're trend following, in my opinion, the way to go about it is to follow and follow and follow until the market tells you it's time to get out. We're getting real close to the news here. I'll come back to the COT data, which will be really important to take a consideration of as we get closer to the event. Again, we've got 1 minute to go before CPI comes out, guys. We've got S&P in the bottom right. We've got gold bottom left. We'll put the dollar index top right, and these are 15-minute candles, by the way. So keep a close eye on this. It'll probably move a good bit here. So we've got dollar, gold, S&P. And for the last one, we'll go ahead and we'll put Euro USD. So we've got all the big charts here for the most part on the screen. And again, we've got about 30 seconds to go. Do me a quick favor. If you enjoyed that, if that game plan, if the breakdown was helpful to you in any way, shape, or form, help me out. It takes 2 seconds. Hit the thumbs up button on the video. It does support what we're doing here. And again, we are coming into CPI. Let's see what we get. Breaking news coming in. All right, and about 5 seconds to go here. Let's see what we get. All right, CPI is out. Dollar index initially popping higher, gold dropping down to 1986. S&P dropped then rocked. Euro USD up, gold up, S&P back up now, dollar index up. Let's see if we can get a print, and we are waiting on it. Not just quite yet, but again, an initial spike higher on gold, S&P, euro, and there goes the dollar. Dollar is down. Seems like there was an initial delay on getting the data. I'm still waiting on it for Forex Factory. So we'll see if anybody has a number. 3.1 as expected. Thank you very much. Okay, 3.1 as expected. Remember what I said, guys. Remember our game plan? What was the game plan? If numbers come out in line with expectations, dollar bearish, S&P gold bullish. Let's see if that holds up. And again, as expected, as expected. Oh, month over month was hotter than expected, but still headline over year, as expected. Core, as expected. Okay, we got kind of an as expected reading, and the forecast that, not the forecast, but the game plan that we discussed seems to be playing out fine so far. Okay, gold spiked. What did you guys trade? Let me know in the chat. What are you watching? What are you trading here? Anybody? Do me a favor, if you have a trade open, like share it in this format. I'm going to show you SPY long. Like this is like my position, right? I'm not saying do this. I'm saying this is like what I'm doing. I have a long position on the S&P. Let me know, what are you guys trading? Are you bullish something? You bearish something? Chat, GBP long. Thanks, Jacob. Yeah, so for example, GBP USD, let's have a quick look at that. And there goes the dollar trading down 103.51. We're seeing so far the game plan is playing out. And this is why, again, I said two out of three scenarios I'm bullish S&P. We are staying in on this one, and this is give me 1 moment to relish in this for a second. I've been trading for a long time. I take a lot of small losses, a lot of small winners, a lot of break-even trades, and I trade all year long, really, to find a trade like this. I've got this trade going. It's still going. The S&P 500 has far exceeded where I thought it was going to go, and that's why when it comes to trend following, I don't like to call a top. When you're trend following, in my opinion, the way to go about it is to follow and follow and follow until the market tells you it's time to get out. So let me brag for just a second. This is one of my better trades this year. I've had plenty of terrible trades. I was wrong about gold recently. Like I'm not just trying to hype my one winner, but this one winner has been something that I've been waiting on and trying to find for a very long time. So I'm glad I finally caught this one. S&P, we're still long. For those of you guys who are in the signals group, we will be updating the S&P 500. I think it's about time we trail a stop further. So I will probably be doing that shortly after stream.
Did you know our market scanning software, the Edge Finder, just got even better? Check out our newest asset, Bitcoin. That's right, Bitcoin was our most requested feature update, and we're so excited to announce Bitcoin is finally here with plans to add even more crypto in the future. We've also updated our most popular feature, the Smart Money Tracker, adding even more data than before. The Edge Finder not only automatically scores 8 different metrics for each asset to give it an overall buy, sell, or neutral score, but it also keeps track of bank and analyst positioning, stores historical fundamental data, shows how assets are trending throughout the day, and so much more. Right now, our YouTube viewers can get the Edge Finder at a discounted price when they use promo code A1YT. You can check out the Edge Finder with the link down in the description below, and again, get it for the special discounted price when you use promo code A1YT at checkout.
Yields coming down, 10-year, 2-year, both coming down here. You like to see that, and definitely good for equities and risk sentiment for those of us following, the Dow, the S&P, the NAS. All three of these generally going to be benefited right now from falling yields. We don't want it to fall too far. Heads up, if this yield falls too far, you know what that means? That means the economy's under pressure, and we don't want that. We want yields to mildly come down. We don't want them to crash, right? It's an interesting thing, but one thing you should recognize is that the 10-year yield is in some ways a representation of the US economy. We don't want the economy to crash. We just want it to cool off so that stocks don't get hit by another Fed rate hike, right? Makes sense? Let's move on. Let's keep going. This is so interesting that ahead of CPI, what was big money doing? Let's check the records here. Institutional money was on the latest money flow filing from the COT data, right? US 30, GBP, AUD, Kiwi. They were all piling longs in the latest filing. And what do we see happening on the news? Well, there goes US 30. Let's check. There goes the pound. Let's check Aussie, right? There goes, well, the Australian dollar hasn't done too much. Kiwi, let's check. Not too much. Let's keep going though. Let's take a look. What about oil? They've been bearish on oil. Let's take a quick look at oil. You see what I'm saying? It's no perfect predictor. Please don't get it twisted. But understanding what smart money flow is doing can be very, very important. So heads up, if you would like a copy of this, again, we are doing Christmas discounts on the Edge Finder right now. If you want access to our COT data, click right into our link that we dropped there. You get access to that there. Again, in terms of net positioning, let's have a look at that. Gold, USD, Nikkei, Euro, these things are generally speaking more bullish from institutional money. However, a lot of times people will look at this section of the Edge Finder because this is like the most intuitively obvious. You're like, okay, so they're really long these things and really short these things over here, right? Kind of. Let me break this down. If you're trying to track institutional money, I don't do that by trying to track price action. I don't think, in my personal opinion, I think price action can be very deceiving to try and track smart money or big money. That's just my opinion. Again, if you have something work for you, do you. But here's something that I will add. If you want to actually see what smart money is doing, why not get it from the actual source that has to, by law, they have to share their reportings week by week. That is the COT data. Okay, so if you want to track smart money, here's how I actually can do it, not as an opinion, not as, oh, I think they might be doing this funny business. Here's the facts. Here's the actual COT data that shows us institutional money, and we can see what their net long and net short. But more importantly, we can see what they did in the latest filing. This report that we built down here allows us to look at what the latest smart money moves actually were. Unequivocally, right? We're looking at the commitment of traders data, the COT, the non-commercials data, and we can see where their money went. Did they go into the US 30? Did they go into the pound? Did they go out of oil? Did they go out of Bitcoin? What did they do, right? Week to week. That's what we track here. So we had the CPI number and a little bit of an interesting price action response. We saw prices move all over the place across the board. Mostly numbers coming out as expected. What do you think about this? Does it change anything? What do you think?
What doesn't, or what does it confirm? It is not. It confirms that we are lower. Inflation is lower. It's according to expectation. Though we have a lot of volatility in the inflation, it is not higher. Secondly, or thirdly, the probabilities of a rate cut in March is, I would argue, 50-50 at this point. We're going to see if that's going to change anything. Of course, it's going to change a lot tomorrow, but I think we're still standing down. Still standing tall. Status quo. I like it. I shouldn't have been like 2 point something. Would be great.
Sure.
But the reason for the price action is because it was already priced in.
Yeah.
So what are the market doing now? It's pricing in tomorrow.
Right. You're seeing a little bit of volatility both directions, perhaps just because markets were kind of already expecting something at 3.1% overall. But you make a good point where what you've got pulled up here, Ivan, explain this a little bit for people who are not familiar with the Fed tool here.
The Fed tool is, or the Fed Watch tool by CME Group is basically they have re-engineered the 10-year and the 2-year Treasury bond yield, and they're seeing at what level are market pricing in future interest rates at which meeting we have in front. So we have one tomorrow, which I believe is going to be like 98% or so. Yeah, 98.4 tomorrow. And then the next meeting in January, we are still pricing in the current, this right here, with a 94% likeliness. And then March becomes the next question because the market has now gone into the naughty corner. Which corner is that? That corner there of we have to cut in March. Then we're going to see a lot of dollar bullishness if that is not by any means met. And I think by December next year, we are most likely to have around 4%, which is 1, 2, 3, 4, 5 rate cuts by the end of the year.
Very interesting. Yeah, and of course, the meaning or the importance here too, Ivan, that you're pointing out is that we're looking out to March and May and all these different times. You guys have to remember that whether you're a day trader or a swing trader, it doesn't matter. Markets are forward looking. They're moving based on what is expected in the future. And again, what started to drag this dollar down is the shift in expectations about when rates are going to come down. Now, of course, as Ivan pointed out, had we gotten a 2.9%, probabilities for a March rate cut would have gone up. And rate cuts, again, that's the candy that the markets is looking forward to in terms of dollar bearishness, but more specifically, kind of a weight off the shoulders of equities, commodities, gold, etc. Right? So really, really interesting point there. Ivan, of all the movement today, is there any chart that you're watching close?
What am I watching close? Carry trades.
Okay.
Carry trades. At least in my mind, because if we are now cutting interest in America, is that going to be the most valuable thing to do? Not really. So that should be a shift in dollar COT. That should be a shift in dollar positions. If that's going to be the case. So which is going to be the strongest one going forward? The question that me and Stefano had this earlier today was the one that's going to hold the interest rate the highest for longest. And who's that going to be? Pound. So maybe looking to buy pound, maybe looking to buy New Zealand, maybe Australian.
Very good point there. I was going to ask again, Ivan, you're the perfect person for this conversation today because I kind of made that big segue, the big book cover here before you came on was, now it's the race for rate cuts. I think that's the next conversation in markets is, Ivan, you and I, we've been following these markets together and covering them together. We talked all the way through the rate hike race when we were talking about, who's going to rate hike. And, at that time it was, the UK was like the laggard of the group to rate hike compared to others. Now the question is, as you just kind of alluded to, is the Bank of England going to be the laggard in rate cuts? And, that's a distinct possibility. We talked about this yesterday when we spoke about the ECB, the Euro area, experiencing already some serious recession. Germany, they're kind of their top dog, right, has already seen serious economic slowdown. And so I don't necessarily think the Euro looks resoundingly strong, but perhaps you made a good point about the pound. So do you have any, is the pound kind of your pick of the litter, or what about the Australian dollar? What do you think?
I think what is important going forward is going to be the CPI, but what we need to establish and what we have established is dollar. Where is dollar going to go? that's going to take the cake, whatever we do. Because if you go back in time and you say go daily on euro has been increasing interest rates in this period, but euro dollar went down because dollar also did. So that's the base case. Now you don't when dollar's falling, who's going to be the strongest? And how do I distinguish between them is, yes, I do read the central bank monetary policy report. I listen to the speeches, and I look at CPI, I look at employment and GDP, and then a bit of risk sentiment somewhere in there, and some seasonality, and I'm probably going to buy all three of them. But
yeah, no, good stuff, Ivan. And I think, I definitely look forward to, as we enter into 2024, having your commentary on this space. I think that is really, really important. And for those of you guys who are listening, what we're talking about here is, at the end of the day, the biggest market movers in the currency world specifically are the central banks. And as we discussed, somebody pointed out in the audience, inflation is still real bad in the UK. These are the things to look out for, right? Because if you see inflation is still stubbornly high in a certain area, and the central bank's commentary is incredibly hawkish still, or perhaps just not nearly as dovish as other places. Now, again, that brings me to another really important topic. Tomorrow, Ivan, we have the Fed statement. We have their decision on interest rates. They're very unlikely to change their rates. However, the question will be, is there going to be any dovish sounding tone? I think as you pointed out, I remember yesterday you made this distinction. The Fed has not necessarily come out and been dovish. They've just been less hawkish. I guess the next question would be, if you are somebody in the camp of we need to see a March rate cut, if that's kind of your expectations, then tomorrow you probably want to start hearing the Fed sound dovish, because they're not just going to, they very much, they are like kind of, if they're not sounding dovish by tomorrow, I think rate cut expectations for March could really get hurt. What do you think about that? And would you agree? Like, is that what if you're a March rate cut person thinking that the dollar is just going to crumble from now until then, you need the Fed to sound really dovish tomorrow, right?
Not only dovish, they need to be done increasing interest. I do apologize for that page. That was the page I was wanting. Inflation, at least for October, at least on Edgefinder, pound was the highest one. So that's what I want to say. Now, for Fed tomorrow, they need to say that the policy has been restrictive. We have seen development, and we are seeing that inflation pressure is reducing somewhere in that direction.
Yeah.
So that they have been restrictive, they have been given they have seen the appropriate response in the market or in the economy. Rate cut or something, at least minimally that. Because right now I looked at the Fed statement from last time. They're still seeing that what would I say? Like they are restrictive, and they're still seeing the possibility of adjusting, which is not the language you want to see tomorrow.
That's you said something, Ivan, there, and I want to extrapolate on it. You said something about specifically not necessarily talking about rate cuts, but you pointed out you need to hear the Fed kind of solidly say we are done with interest rate hikes. That is probably the next step. So I kind of jumped to the idea they need to sound dovish, they need to talk about rate cuts, but they're probably not going to jump to that. But the halfway point that markets would probably love to see for dollar bears and for stock market and gold bulls, they would love to hear the Fed say solidly, we're done with the rate hikes. We're if that happens, that's a huge win for dollar bears. Is that kind of what you're saying?
Yeah, and then you have January. And then you have March. So there's another meeting. Secondly, or thirdly, or fifthly, or whatever. There's not going to be any policy change tomorrow. It's not going to be like, oh, we're gonna stop whatever we're doing.
Right.
No, that's not going to happen. It's just going to be slight change, and then January comes around, and there we're cutting rate. Then what they have to say, like interests are appropriate. We have seen enough disturbance in the market. Okay, exact words. They are seeing that their policy is restrictive. That they see the economy is slowing down, and therefore they need to end whatever they're doing.
Yeah.
And that's what you need to see in January. So what you're looking for is January.
Yep.
That dovish. That if that doesn't come in January, then we are.
Yeah, because then your hopes for a March rate cut are very, very wishful thinking.
Don't forget to check out the links in the description if you want our broker recommendation, access to our free Discord, free Edge Finder, or want to chat with us on Telegram. Remember, you can watch us live in the markets every morning starting at 9:30 a.m. Eastern Time, and we have lots more free trading tools and content available on our website, a1trading.com. Thanks for watching.